Welcome, everyone. Today, we are diving deep into Premier Energies Ltd. They're a major engine in India's clean energy sector. And our focus, it's squarely on their Q2 FY2026 financial results. These just dropped October 28th, 2025.
That's right.
And look, this isn't a company just ticking along. No, this is a company in a full sprint, really attempting an aggressive capacity expansion that just dwarfs their previous plans.
Exactly. And our mission today really is to get beyond just the raw numbers you see in the filings and the investor presentation.
Right.
We want to use this data to understand how this one company is making a huge multi-billion-dollar bet. I mean, it's not just on solar's future, but really on the whole future architecture of India's power grid.
Okay, so here's the central tension, the strategic puzzle we need to unpack for you. Premier Energies is trying to do two massive things at once. They're scaling up their core stuff, solar cells, modules to levels we haven't seen before, but simultaneously, they're also attempting this rapid, pretty high-stakes diversification, moving into totally new, though related, products like transformers and inverters.
Yeah.
Now, wait a minute. Isn't trying to hit that kind of aggressive scale and launch new divisions at the same time, isn't that just a recipe for, catastrophic risk, managerial overload, capital overload? How are they managing that?
Well, that's the perfect question to kick off with because, the strategy does feel a bit counterintuitive.
Right.
They seem to be betting that the policy environment, the government support, provides a stable enough foundation to handle both vertical integration and horizontal diversification at the same time.
Okay.
And these Q2 financials, they're really the first proof point, the first test of whether this juggling act is actually sustainable.
All right, let's dig into that scorecard then. Section 1.
Yeah.
The Q2 financials. Robust growth, financial strength. Let's start with the headline numbers. The Q2 FY 2026 consolidated performance. It shows, remarkable power. Total income hit INR 19,214 million.
Yeah, and the revenue from operations specifically was INR 18,368.65 million. That's a solid 20.3% jump compared to last year.
20% is pretty strong, but the profitability, that's where it gets really interesting, isn't it?
It really is. I mean, look at their profit after tax, the PT. It surged 71.6% year on year, 71.6%. Came in at INR 3,534 million.
Wow.
That kind of margin expansion, gives them a really healthy EBITDA margin of 33.59%. It signals they're not just selling more stuff.
Right.
It means the regulatory protection, which we'll get into, is letting them keep decent pricing power and really control their costs well.
Okay, usually when a company announces these huge expansion plans, and we are talking billions in investment here, you kind of brace yourself for debt levels just skyrocketing. But this report, it actually shows improved financial health. That seems like a key indicator they're scaling responsibly.
That's the critical insight, I think. And it ties back to your earlier question about risk. They actually managed to reduce their net debt substantially.
Reduced it. How much?
Well, it went from negative INR 10,570 million in Q1 down to negative INR 5,673 million this quarter.
Wait, negative net debt. Just clarifying that for listeners.
Sure. So when net debt is negative, it basically means they've got more cash and liquid assets on hand than they actually owe in debt. So the key takeaway is they're funding this aggressive expansion largely from a cash positive position. They're minimizing their reliance on, expensive market borrowing.
That definitely lowers the temperature on that risk profile we talked about.
Exactly. And the result, their total debt to equity ratio actually improved slightly, dropped from 0.49 down to 0.47.
So they're not just growing, they're strengthening the balance sheet while they do it.
Precisely. And operationally, they're also squeezing efficiency out of their current assets. Their existing cell production capacity ran at 79% utilization. That's 507 milliW produced.
And modules.
Same story. Module production also hit 79% utilization, churning out 961 milliW. They're maximizing what they have now while getting ready for that future scale.
Okay, one last financial point, and this, I think, tells you a lot about their whole strategy.
Yeah.
Their order book, huge. INR 132,496 million. As of September 30th, it's 100% domestic.
100%.
Yeah, cell orders make up, 59%? Modules, 40%. This isn't just market success, is it? It feels like a deliberate, policy-driven move to insulate themselves from global market chaos.
That 100% domestic order book brings us perfectly into Section 2. It leads us directly to the fundamental driver here, the policy landscape, specifically the one engineered by the Indian government to boost domestic solar manufacturing.
Right.
The environment is just well, perfectly tailored for a domestic champion like Premier.
Yeah, you see that tailwind everywhere in the sources, don't you?
Yeah.
The government slashed GST, the goods and services tax on solar cells, modules, and inverters, cut it from 12% down to 5%.
Which immediately cuts the final project cost. It's a huge stimulus for consumers, for industrial uptake. And then you've got the protective shield. The Directorate General of Trade Remedies, the DGTR, think of it as India's trade firewall.
Okay.
They've recommended anti-dumping duties, potentially up to 30%, on imported Chinese solar cells and modules. That gives instant price protection, instant stability for domestic players who comply.
And that compliance, that protection mechanism, it really centers entirely on the ALMM, right? The approved list of models and manufacturers.
Exactly.
This phased rollout is key because it gives them crucial visibility on future demand. ALMM started back in 2024, and ALMM just became mandatory for utility-scale projects bid from September 2025 onwards. That creates a pretty big moat around domestic players.
And if we connect this directly to their Mission 2028 expansion plans, the proposed ALMM3, well, that's the most aggressive policy move yet.
How so?
That policy essentially says that for certain big government-linked projects, the entire supply chain, including ingot wafer manufacturing, has to be domestically sourced and completed by June 2028.
Wow, the whole chain.
The whole chain. It acts as this massive gatekeeper. It's not just a suggestion. For companies like Premier, it's an existential requirement. If you want a slice of that big domestic market after 2028, you must be vertically integrated all the way up to ingots and wafers.
Okay, that explains the staggering scale of their Mission 2028 capacity expansion then.
Absolutely.
They're boosting their cell project capacity from 4.8 GW way up to 7.0 GW. That's targeted for completion by September 2026.
Right.
And at the same time, a massive 5.6 GW module manufacturing plant is going up in Telangana, scheduled to be done by March 2026.
And that final piece, the ultimate vertical integration step, the ingot wafer plant, that's the direct response to ALMM.
Right, the mandate.
Exactly. They originally planned, I think, 2.0 GW, but they've upped the scope now to 5 GW. That's a huge commitment.
5 gigawatts.
5 gigawatts.
Yeah.
Targeting completion by December 2027. Look at the timing. They're clearly racing to beat that government deadline to make sure their market access stays locked in.
And the demand visibility supporting this explosion in capacity seems enormous, too. The sources suggest that potential annual demand just from the DCR schemes, things like PMU-SOM, PM Surya Ghar, the CPSU scheme too, could be over 92 GW over various timelines.
Yeah, it's substantial. They're not just building for today's demand, they're building capacity for that guaranteed, mandated future demand.
Okay, let's pivot now. Section 3. Diversification. The other side of the Mission 2028 coin. They clearly believe that relying just on cells and modules, even at massive scale, is, well, too narrow a focus.
Yeah.
Their internal goal is for these new allied products, inverters, transformers, BSS, to eventually contribute about 25% of group revenues.
And what's really fascinating here, I think, is how they're doing it. They chose acquisition over trying to build these capabilities organically, much faster. They used strategic purchases announced literally just before the financial report came out, October 23rd. It allowed them to instantly jump into these critical, fast-growing parts of the whole clean tech ecosystem.
Okay, so the first big move was into inverters. They acquired a 51% joint venture stake in K-Solar Energy Private Limited. That cost them INR 867 million.
Right, and this move is, well, policy perfect. K-Solar already has significant capacity, and it's set to double by June 2026. But crucially,
Yes.
the Indian government has mandated India-based data storage for any inverters used in that huge PM Surya Ghar rooftop solar scheme.
Ah, the data localization role.
Exactly. So this acquisition instantly aligns them with those national infrastructure requirements. It basically ensures their new inverter business can immediately capture a piece of that big subsidized domestic rooftop market.
Clever. Okay, then the second acquisition, this one feels much bigger, targeting the really fundamental infrastructure needed for this whole energy transition, transformers.
Yeah, this was a significant check they wrote. They acquired a 51% stake in Transcon Limited for a substantial INR 5,003 million.
Whoa, okay.
Yeah.
That's nearly 6 times what they paid for the inverter company.
It tells you exactly where they see the core supply bottlenecks and therefore the highest potential margins in India's grid infrastructure right now. They're aiming straight for the backbone of the grid.
And it's not just Transcon, right? It's
Yeah.
kind of a dual transformer play.
It is. They're aggressively expanding capacity at Transcon itself, aiming for 4.25 GVA by January 2026. But they're also launching a JV, a joint venture with Neotrafo Ltd, to reach a combined 10 GVA by April 2026.
10 GVA, that's a lot of transformer capacity.
It is, and they're moving rapidly into the higher margin equipment too. Medium voltage, MV, high voltage, HV, even extra high voltage EHV transformer.
That big stuff.
The really big stuff. These are the specialized, large-scale units you absolutely need to integrate massive amounts of new renewable energy capacity. Plus, they handle the overall electrification push across the country. Demand for these is just soaring, globally and especially domestically.
Okay, and finally, the sort of future play that completes the ecosystem picture. BESS, Battery Energy Storage Systems.
Right. They've got a manufacturing plant already underway in Pune, Maharashtra. That's targeted for commissioning by June 2026.
And why BES now?
Well, this move is crucial. As you get more intermittent renewables, solar, wind coming online, storage stops being optional. It becomes mandatory for grid stability.
Makes sense.
And the sources confirm it. Cumulative BAS tenders are just soaring in India. So by combining solar manufacturing, inverters, transformers, and now BES, they're positioning themselves to potentially bid on entire end-to-end EPC contracts.
Engineering, procurement, construction, the whole package.
Exactly, where controlling all the key components yourself streamlines the whole process and ideally maximizes your profit.
Okay, the scale of this domestic ambition is, frankly, staggering. But Section 4, we have to address the elephant in the room, the international market.
Right.
That 100% domestic order book we talked about earlier, it's not just a coincidence, is it? It feels like a necessary defense against some pretty hostile global headwinds.
That's absolutely right. The international trade environment is severely challenging right now, particularly with the U.S. market, which is usually a massive destination for solar components.
Specifically, the U.S. slapped a huge 50% tariff on Indian imports, right? Effective back in August 2025.
50%. And it's composed of two parts, a 25% reciprocal tariff plus another 25% penal levy that's linked to India's continued oil imports from Russia.
Ouch. That makes exports almost impossible to price competitively, doesn't it?
Pretty much. It raises the question, why even bother trying to export when you're facing that? Even with things like the IRA incentives in the U.S. potentially helping some manufacturers, Indian exports are just facing immense hurdles.
And it's not just tariffs.
No, it's compounded by the U.S. launching these comprehensive 80 CVD investigations, that's anti-dumping and countervailing duties. They're alleging dumping margins as high as 123% on cells and modules from India. So this external hostility, it's the explicit reason why a company of Premier's scale has basically zero global orders right now. The government's domestic policies are effectively shielding them from this ongoing trade war.
That context really makes their total reliance on domestic policy understandable, even necessary.
Yeah.
Okay, but switching back from external pressures to internal strength, the sources spend quite a bit of time on the company's ESG commitment. Environmental, social, governance. It's presented almost as a core foundation, not just some corporate afterthought.
And they provide some tangible, pretty advanced metrics here. On the social side, for instance, they report 38% female employees actually on the shop floor.
That's high for heavy manufacturing.
Very high for India. And 25% women on the company board. Again, significantly above the norm. They also highlight the creation of 8,558 green jobs, showing that community investment piece.
And environmentally.
Well, they operate India's first LED gold-rated solar manufacturing facility, but maybe more importantly, operationally, they practice zero liquid discharge. ZLD. And that's not just a sustainability badge, it's a massive operational efficiency win. It results in them recycling 75% of their water and then reusing 80% of that recycled water. Very efficient.
Impressive.
And tying it right back to their core business, they calculate they avoided the emission of 24 million metric tons of CO2 equivalent just in Q2 FY2026, simply through the supply of their modules and cells.
Okay.
So this whole sustainability profile, it provides a really strong narrative, both for domestic stakeholders and potentially for international investors down the line. It signals a long-term, sophisticated approach to how they manage their operations.
All right, so let's wrap this up. What does this all mean? This deep dive, it really reveals a company betting the farm, essentially, on the next 5 years of Indian clean tech policy. We see clarity in their Mission 2028, that unprecedented push for scale, going fully vertical all the way to ingots and wafers, just to secure that domestic market access dictated by ALMM. And we also see complexity. That rapid high-stakes diversification into allied products, inverters, transformers, BESS, aiming for a full quarter of their revenue from these new critical engines of grid growth.
Which leads us to the final important question, something for you to really think about. Premier Energies is leveraging extremely strong domestic policy to fuel all this growth, keeping its order book 100% shielded from those global tariffs.
Yeah.
Now, given that they are aggressively building this fully integrated supply chain all the way up to ingot wafers and simultaneously moving downstream into BSS and transformers, how far can this purely domestic champion really go? How big can they get before the sheer size and output of their factories inevitably force them to confront those massive global trade tensions like that 50% U.S. tariff, and maybe, just maybe, fundamentally rethink their purely domestic market strategy?